Thank you all for joining us this Thursday evening for another edition of Mwango Spaces. We have a special guest with us. He's from Stanbic, Kenny, and he's going to explain to us what he does there. So I'll introduce you in a few. My name is Eric Mokai. I'm the founder of Mwango Capital. Kingori, karibu sana to Mwango Spaces. I know it's your first time here on Spaces. I think generally on Spaces too, it's also your first time. So I'll give you this moment to briefly introduce yourself and say what you do.
Thank you very much. It's a real pleasure to be here with your audience. As you said, my name is Kingori Gavinji. I'm the head of investments and financial fitness at Stanbic Bank, Kenya, which is part of the Standard Bank Group of South Africa, which is the largest bank on the continent by assets and has been present on the continent for over 160 years, has been present in Kenya in different iterations for over 100 years. And we say Kenya is our home, we drive her growth. Africa is our home, and we drive her growth.
Break down a bit about what you do. You're the head of investment and then you're also financial fitness. Break down those two kind of roles. They feel separate at the same time linked. So you can give us a bit of flavor on what those entail.
Absolutely. I normally get more interest in the financial fitness. It is a catchy phrase that it's one we've actually trademarked as a group, the Financial Fitness Academy. But perhaps I can start by talking about what I do as a head of investments. So as an integrated financial services organization, this is Stanbic Bank, we have a range of capabilities across our footprint. There's many things we can do, to put it in simple language. But with these different capabilities, when our clients walk through our doors or pick up the phone, it's often helpful to speak to somebody who can help you make sense of it all. So my job is I work as an intermediary within the bank. I take capabilities that we have in different parts of our bank, from our global markets team to our securities business, to our investment banking business, and I bring them to bear on issues that clients bring to our attention. So essentially, I'm helping you navigate the Stanbic Bank system along with my team. So whether you're looking to invest in stocks, bonds, structured products, money market funds, we are there to help you figure out how you can put it all together to work for you. So that's what I do as the head of investments. In the Financial Fitness Academy, a program I run with a colleague of mine, LC Minor, what we're doing there is financial literacy on steroids. So we're saying financial literacy is well understood. People know the idea, and I know Mwango has done a lot in this space. But we're saying as a financial services organization, we believe we can take it one step further to application in a very practical way. And at the Financial Fitness Academy, we work with our partners, with our clients, with different individuals to help them actualize the things that they know about money and put them to work with the solutions we have available. I hope that makes it a bit clearer what it is that I get paid to do.
Yes, we can start with the financial fitness a bit. How do you declare someone financially fit?
Absolutely. And goals are important. And sometimes working towards goals, even though they may seem elusive, is important. And I really do applaud the work that Mwango Capital is doing and other players in the market are doing in trying to get people to be more in control of their finances. So let's talk about financial fitness. First of all, we call it the Financial Fitness Academy, and it's a program that we have run as Stanbic Bank for now nearly 7, if not 8 years. What's interesting, and I may be running ahead a little bit here, is we started it internally. We were looking at ourselves as bankers and saying there seems to be a problem. We work in the money markets, we work in the money industry, but sometimes it seems that we're not very good at managing our own finances. So the program was mooted, and it's a program that essentially takes the participant through a journey of how they make their money, to how they spend that money, to how they save and invest that money, to how they give that money, and we call that share and legacy. And finally, to how you plan and protect the money. So it's a 5-fold approach to what we believe are some of the key elements that go into being financially fit. And we call it the Wealth Framework, and it's out there. We've done it for thousands of individuals. This year alone, we are approaching 6,000 individuals who've been through the program. It's free of charge. We offer it to anyone who's interested, and we have an app as well. It's called the What Matters app that you can go to and get to know more about the Financial Fitness Academy.
Can you break down those 5 things once again and check us through each thing step by step?
Absolutely. So let's start. And if you are following me in your mind, you can put this picture of a wheel. And at the top left or at one quadrant, you've got create and build. Now, when you're talking about, and I know the subject of our discussion this evening is building financial resilience, it's tempting to think to yourself, it's only about how much money I need and getting more and more money, and that is a number that would make you financially resilient. But in Create and Build, which is the first of the fivefold concepts within the wealth framework, we ask you to consider, are you clear about what exactly do you bring to the marketplace? What is your skill set? And we are really big on continuous learning, as we are trying to do this evening. We believe in this age that if you do want to be resilient, don't even talk about financial resilience, just simply resilient, you need to continuously upskill yourself. So in Create and Build, we ask you to be conscious of, one, what's your hustle? How do you make your money? And then what are the skills that you could leverage to amplify that? So you may be able to start a side hustle. You may be able to simply scale up what you are doing, take it to the next level. And we start there with Create and Build. Then in Live and Enjoy, as it suggests, we're saying life is about the living, and people work hard so that they can play hard. But as you do that, you need to do it to a plan that speaks to who you are, the things that you stand for. And we introduce a budget in an overt way because people understand budgeting theoretically. But here we challenge you and we ask you, are you actually living your life in a way that can be said to be living to a budget? And when pushed, we challenge the participant to say, does that budget speak to your priorities? We introduce a concept called the 50-30-20 rule. It's understood, it's common. But for us, it means that you need to be aspiring to live on 50% of your income, save 30% of your income, and invest 20% of your income. And that becomes Live and Enjoy. We also talk about debt management. We talk about acquiring good assets. And it leads us on to Save and Invest, which is courtesy of being in the investment space, a place that I feel very at home. And here we talk about the importance of saying, once you've understood how you're bringing in the money, you've understood about how you're prioritizing your spending, then you make that critical decision about where will I invest. And in Save and Invest, we talk about the double-fold importance of both saving and then investing, and one leads to another. And we talk about the range of assets that are available and courtesy of who we are as a bank, as a stockbroker, as an investment bank. There's a lot that we bring to the table, and we tell people to consider, are you building this diversified portfolio that would help you navigate the world of risk positively? In Share and Legacy, we talk about a few somewhat taboo subjects. We talk about the things that people don't like to talk about, death, and how you're thinking about the inevitability of it. Are you planning? Are you sharing your instructions? So what I'm doing, Eric, in my long-winded answer is giving you a whistle-stop tour of the Financial Fitness Academy in the Wealth Framework. It's normally a 1.5 hour, longer than even we have now. But we complete it, Eric, by talking about Plan and Protect. And in Plan and Protect, as you would imagine, we talk about the importance of insurance, amongst other things, insurance and financial planning. And here what we are saying is, you can do everything within your power and your control. You can make the money. You can be disciplined about how you spend it. You can save and invest diligently. You can have a plan for how you plan to give it back. But there are certain things you cannot protect for or guard against. And for those, we say insurance is important, and it all works together to ensure or to enhance your financial resilience.
You've taken us through the 5 steps in rocket speed. So I want us to break it down a bit before my interest in Share and Legacy, people don't talk about it a lot, but we'll get there. So let's start first with the Create and Build perspective. For someone who's listening to us, in the Create and Build perspective, what are you trying to encourage someone to do? Diversify incomes, that also see, compare expenses versus a budget and all. So can you break that down? Let's start with the Create and Build perspective.
And even as I do, if you're on the call and you're asking yourself, okay, how can I be more a part of this discussion, feel free, even as I speak, to go on to the App Store, to go to the Play Store, download the What Matters app, and you will be able to follow a lot of what it is now we are digging into. So let's talk about Create and Build. Like I said, in Create and Build, when we started this discussion about financial fitness, we said, what are some of the misconceptions? And I'll tell you, people expect that when you're talking about financial fitness, you will come in and you'll be straight into this product. But there's a mindset. There's a mindset to all of this. And Create and Build is about addressing that. And we start with an interesting concept that's borrowed from a professor at MIT, Dr. Peter Senge. And it's about the creative tension in our financial journey. And it's about starting with the end in mind. and we challenge you. And even on this evening, I would challenge you because there are so many influences in life. You're hearing from a person who's been in the market, I begin to influence your thinking. But are you clear yourself about what that bigger picture is, where you're trying to get to? And we say visualize out outcome because the tensions, and he illustrates this with an interesting example where you simply take your stronger hand, your dominant hand, your right or your left hand, put it out in front of you, and consider that dominant hand to be your preferred financial future. And Stanbic goes on to say, I'll prove that tension will always resolve itself to the more stable state, to that preferred financial future. So we're saying, when you're clear that my goal is to retire at a particular age, maybe 50, maybe 40, I'd like to retire on a particular income, you can then begin to work backwards and create a pathway. So create and build is about addressing the mindset of an individual. So right now I'm addressing your mindset. When you think about financial resilience, when you think about financial fitness, start with a clear understanding, as clear as we can be, about where we are trying to get to. So create and build is all about thinking about the value. How do I currently create wealth? And then we also ask you to consider, think of the ways you could leverage your skill set. So, for instance, I am an investment advisor. I work for Stanbic Bank. What else can I do to enhance my value in the marketplace? How can I maybe take the route of Eric one day, if it allows, and reach a wider audience? And how can I then amplify the ability to earn? And then we also ask individuals, and here we're looking ahead to plan and protect, to consider what are the risks to your ability to make money. And people don't often do that when we are thinking about how we plan. We tend to focus just on the opportunity we see. We don't think about the risk. Here we're saying, what are the risks? And I know we may get the opportunity to talk about AI, but in Create and Build, we are saying, are you remaining relevant? Are you upskilling yourself? So Create and Build, and if you go onto the app, you will see it simply sets a foundation. It asks you, if I was to introduce a somewhat biblical metaphor, to consider what is in your hand. If I talk about my own background, I studied law. That's what I was certified to go out and do in the world. But courtesy of mentors and exposure that I got, I very quickly gained a foothold in financial services and investments in particular. So Create and Build is about considering what's available to you. How can you leverage it? What are the potential risks that it poses? And then we conclude Create and Build by an interesting illustration. It's been said in Kenya, I'm sure in many places around the world, that in Kenya, everybody has a side hustle. Everybody has a second gig that they are running. But interestingly enough, you tend to succeed at what you focus on, what you devote yourself to. And we point out that whether you're an entrepreneur, whether you're a corporate employee, whether you're a recipient of inherited wealth, call it what you will, there is a function of time to the creation of wealth. And in Create and Build, we task you to be prepared to look at your wealth journey as a marathon rather than a sprint. So that would be one quadrant. Eric, would you like me to continue to break down the rest, or do you want us to reflect a little bit of Create and Build?
Let's reflect a little bit, because one of my really favorite quotes is from Charlie Munger. Always says that every day you spend time in terms of becoming better each day. And in that perspective, then you're compounding that knowledge and experience long term. In reflecting on your own journey and some of the people that you've worked with, what are some of the key reflections, or at least things Kenyans should think about as they create and build?
Absolutely. That's a wonderful quote from a very respected individual when it comes to creating wealth. Not as well known as many would hope, but really very well respected. And he's absolutely right. And I'm really hoping you get to see the visual depiction of those different wealth journeys, because it's statistically driven that an entrepreneur will see an up and down approach to the creation of wealth. A corporate employee will probably associate himself with a rise and somewhat linked to inflation and tends to gradually increase over time. If you've inherited wealth and you are under the pressure, you will tend to find you peak initially and your task becomes to maintain it. But what all those things have in common, and what Charlie Munger is reminding us about, is you build an expertise by function of time. It's been said that we are what we repeatedly do. And if you inculcate good habits and build on, and something I would encourage anybody who's looking to accelerate their progress towards financial resilience and stability, is you don't need to repeat. It is to repeat. And where perhaps I may not win as much support is saying the idea of a side hustle as its setbacks. Let me explain what I mean. People will work a full working life in a particular industry. Perhaps I work as a banker. And then as I approach retirement, which I will soon be doing, I begin to say to myself, I've always wanted to run a business. And then I jump in with both feet, which is ill-advised, into something that I have not yet built up experience in. I don't have the cash, don't have the networks. I haven't built up, if you like, the street credibility that justifies the risks that come with what is a new venture. So I would say on that point, Eric, one must be very careful. If you are truly called to a particular line and you are biding your time in corporate or elsewhere, but your big dream is to be a particular thing, then your side hustle should be about gaining that experience progressively. It is a risky approach, and risk has many aspects to it, but it's a very risky thing to arrive at 30, 40, 50 and to simply do an about turn and head into something that you have not built up an experience around. So create and build is about credibility that you give yourself. And for me, I can certainly say, having started out in the law profession, having been exposed to people who I am immensely grateful to, I recall one particular individual who walked me through what the money markets meant. And this I'm talking about the interbank money market. And I sat across his desk for about a year and a half. And I really owe my whole career to that sort of mentorship. But it took time. It took time.
Some of the mistakes that people should look out for in the create and build stage before you go to the next stage and exploit.
Mistakes, first of all, are not the end of the world. In fact, they say, if you're not making any mistakes, then you're not taking enough risk. But I would say hopping from one venture to another, becoming a serial entrepreneur in the name of gaining experience is probably something you want to avoid. It can be very expensive, and people, you have friends who have been moving from one venture to another without experiencing the success they are hoped for. And this is the tragedy sometimes, without also appearing to learn from the failures. So even when Winston Churchill said that the definition of success is moving from one failure to another without the loss of enthusiasm, I don't think it is our license to start one thing, not succeed, fail, and then move, because you will be eroding all sorts of capital to achieve that. So I would say the mistake that one should be careful about repeating is moving from venture to venture, thinking to yourself that it is the venture that has the problem. Rather be more introspective, be humble, which is not something we often see of entrepreneurs. Overconfidence is a real killer. Because when you're overconfident, you will not see the obvious, you will not see the red flags, you will not take advice. So it's a balance of confidence in your ability, but you also need to be humble so that you can read the signs that are telling you this is not the path to form.
Move to the next stage, you're going to speak about 50-30-20 rule, that you live within 50% of what you earning, 30% for 20% for investment. Break that down for us, and given the state of the economy, we live hand to mouth. I want to explore that bit also. Let's start with the framework. How can we live in joy? Because that's the second stage now.
And the way we describe live in joy, and yes, we are now moving to the second quadrant of the financial fitness wealth framework. In live and enjoy, it's all about maintaining your chosen, and you can underline chosen lifestyle, so that you can realize your plans, your dreams and aspirations. And these will vary, and we are never prescriptive. Remember, most of the time we're doing these things in the context of adult education, which is its own challenge, because financial fitness and financial literacy, unfortunately, aren't always introduced to us at a younger stage. But when we are grown, it really is about, are you making deliberate choices, or are these choices being made for you by circumstance, by peer pressure, which can still exist well into your 30s, 40s, and 50s. I am sensitive to the fact that for some people, their lifestyle can appear to be circumstance-driven, not chosen. They are hustling, they are trying to get to the place where they can be more deliberate about the decisions they're making. But the truth is, there is also a large constituency of people who are simply making choices that do not speak to their innermost values. So in Live and Enjoy, we introduce the budget, or shall I say reintroduce the budget. And we do it with a wonderful quote that I'd like to share with you. It's from Will Rogers. We can't take credit for it. But Will Rogers wrote that too many people spend money they earn buy things they don't want to impress people they don't even like. I've been known to describe that in a language you might recognize as a version of witchcraft. That you would be working as hard as you are working and motivated by people who do not know your story or where you're coming from. So with that quote, we then ask you to reflect and re-examine your spending. It may be as simple as actually drawing up that budget. You will notice the 50, 30, 20, which I'll come to, is perhaps the last point. Everything is about mindset. Everything is about saying to yourself, from today, I want to live on a budget and to a plan. But let me say a little bit about 50, 30, 20 in its principles, because the actual 50, 30, 20 really should be tailor-made to your own situation. But in principle, we're saying you should live day to day, month to month on about half of your income. So 50%. Your goal should be to be able to save or to defy expenditure for at least 30% of your income. So this is money you are creating by making sacrifices. And Eric, I think we need to be clear. This is a journey. You will not be able, in all likelihood, to start out from the start, particularly if you're just starting out on a starting salary or maybe even not a steady salary. It will be very difficult to achieve this. But the goal is to get to the place where you are saving a substantial part of your salary, and we say that's 30%. And then when you do that, you open up this 20% that we call future financial goals. This is the amount you invest. So we are saying to you, aspiring to live on 50% of what you earn, you're looking to save 30% and build in this cushion as early as you can begin to do it. And then you're beginning to invest for the future, looking to invest 20% or more of your income. We call it 50, 30, 20 for ease of recall. It is simply a budget, and it's a way to discipline yourself about where you're going. My colleagues within the industry, including within our sister company, Liberty Life, put it differently. They talk about labeling your money. So here you're labeling your money so that you know where it went rather than wonder what happened to it. And it's a core part of Live and Enjoy. And it then becomes the starting point for a discussion that we dig deep into. One, about how you manage debt in that context. Where does it fall? What is too much debt? What is too little debt? We talk about the importance of assets in your wealth creation journey. What are good assets? What are bad assets? And then we address the very sensitive issue, or if you find yourself overwhelmed, you are already in that hole that we hear about. Yes, you should stop digging, but as you stop digging, how do you get yourself out of the debt traps many of us have found ourselves into? So it's that sort of discussion we would have in Live and Enjoy. We would settle you on the idea of a budget, challenge you to begin to live to one, and then talk about debt management, talk about acquisition of assets, and then talk about how you get out of debt traps.
So then there's a lot to unpack there, because then you're talking about assets, living debt-free. There are a lot of tidbits there that you could share. As a summary, though, from your gleanings, from your clients that you've worked with, what are some of the things that maybe people overlook in this stage of living in joy?
There's a couple of things, and it's a good question, and you are very right. My hope, Eric, is on an evening like this, that we as Stanbic Bank are unlikely to be able to boil that metaphorical ocean. The idea is we want to just warm you up to the ideas of what you can do with a financial partner like ourselves across the spectrum. But let's talk about this issue of assets, because assets is an interesting one. First, assets and wealth seem to walk hand in hand. And the goal, I think, for everybody is you're looking to acquire assets, one kind of another. You call them lifestyle assets, investment assets, this or that, but you're looking to acquire assets. So we have a simple, very simple, and a lot of what we do is really to address maybe things that we have done wrong in the past, which is complicate the subject. So you will notice that our approach, hopefully you can agree with me, is really very simple. And we have a simple two-step test that I would ask you to apply to what you're calling an asset today. One, does it generate income? Does it increase in value? And based on that simple two-step test, you're able to determine whether you hold it, one, an asset as a good asset or a bad asset. And a bad asset is simply the inverse. But if you have something you're calling an asset, and it could even be a plot of land, and it is not generating an income, and lo and behold, it is decreasing in value, which may seem like a misnomer, but it's important to remind ourselves that the idea that land will always appreciate in value has been debunked. And not only has it been debunked, it has been shown to be able to cause catastrophic effects, as we saw in 2007 and 8 with the global financial crisis. So land is an asset like any other, and it should generate income ideally. And it does tend to appreciate in value, but not always, especially if it's not well selected. So for us, we ask you to say, one, even as you look to acquire assets, whether you're looking to acquire them on debt or save towards them, apply the test. Ask yourself, is it generating income? Is it increasing in value? While I have the opportunity, I'll also talk about debt itself, because debt, and I know you made the introduction that we are not discussing this in isolation. I think we know that debt has become a topical issue, a national issue, if you like, has capacity to accelerate your journey toward wealth creation. But it absolutely has the capacity to slow you down to a halt, literally. It can drown you. And what we are saying is that there are ways to lower debt. It should be your goal to live debt-free. But debt in itself, and you'll not be surprised hearing from a banker or an investment manager, that debt is not bad. But you need to look at the ways in which you manage that debt, that it is sufficient to amplify what you're trying to achieve, but it does not become a burden that you find yourself servicing debt rather than growing assets. So I've taken a little bit more time, Eric. I've broken down that once we depart from this fairly conceptual understanding of having the 50-30-20 at work in your budget, then you begin to ask yourself, okay, with the 20, what will I do? And I know we'll talk about save and invest, but that you manage that aspect of the debt a bit, and you be very clear about the assets you're looking to acquire by applying that simple two-step test.
My key takeaway is that we need to be thoughtful about asset acquisition, thinking a bit about the debt itself. One warning, at least for my interaction with a lot of friends, is never to borrow, especially for expenses that are frivolous, in the way that you don't borrow for a holiday. So I think those are like small gleanings here that can help you to be strategic in terms of how you think about your money. Is that something you'd recommend also?
Absolutely. Like I said, we try and challenge you to speak to your priorities as an individual. I'll tell you what I've found, Eric. When I'm speaking, and like I said, I speak to adults, I speak to people who are well on their journey of wealth creation. I've always found that all these interventions to work better, they need to align to your values. Now, follow and you only live once, you may think is a dangerous philosophy, but there are people who swear by it, and they will work very hard, play very hard. They will take debt aggressively. They will deploy it aggressively in ways that somebody else would consider very risky or perhaps even reckless. And there's very prominent people, some of them leading world powers today, who are known to have built themselves with debt. But certainly, I think the idea is to understand the nature of the beast. Debt can certainly accelerate your progress towards your goal. But if the debt is being taken to acquire what we consider a bad asset, potentially that holiday that you take a loan for, and it's a short holiday, and you take a long-term loan and you're paying for long-term, could be a dangerous thing. But by the same token, if you are taking debt because you realize the markets have woken up, and indeed many would say they have in 2025, it's become the year of the share or the year of equities, and you think, I want to leverage my position in the market. I see an opportunity. It may be an aggressive approach, but it could work. So what we are saying is understand it. Whatever you do, we talked about what marks you as financially fit rather than simply financially literate, is that you're able to maneuver, you're able to adapt. In the past, say, 36 months, 3 years, interest rates have risen significantly. There will be seasons when debt is more affordable. Those are times to borrow more. When debt becomes more expensive, then you need to be able to adapt. And that adaptability is what leads to the resilience we are discussing this evening. So I'm inclined to agree with you, Eric, perhaps not for a holiday, but then again, like I said, it's what matters to you and what you feel would be best for you as an individual and your family.
Now we need to move on to the next stage, which is save and invest. I think we talked about it at the party 20. So I think we can now get into that to make so how does someone save and invest? And I think here I want to ask you an honest question from honest Kenyans who would ask, where do I get the money to invest if I can't meet my basic needs?
I hear you. And it's a difficult question. It's a difficult question. And it's one I've been asked before. And sometimes one wonders. But let me start here. First of all, we use the terms interchangeably very often. Save and invest, save and invest. In the Financial Fitness Academy, we draw a distinction. Saving for us is a precursor to investment. Remember 50, 30, 20? Think of it as an evolution. First of all, get a hold of how do I survive? Because if you cannot survive, then investing can seem like a rather insulting conversation that I'm agreeing with the people who would speak to that. So we start with the 50, what it means in your context. And the hope is that we are all evolving. We're all on a journey, that the opportunities are emerging and that we can evolve. When you get to the point that the 30 begins to make sense, and remember the 30 is now talking about what you can save, the sacrifices, the cost cutting, the eating at home instead of eating out, the carrying lunch instead of eating at the cafeteria, the taking the bus instead of acquiring an aspirational asset like your first car. Extend how long you dip on the bus, we probably will save quite a bit. And when you now have those savings beginning to grow, don't stop there. And indeed, many people do, and they become the victims of inflation, which affects all of us. You can then meet that final step. So I am trying to answer your question for the individual who says, you lost me at investing, because I didn't start at investing. I started with your mindset. I then took you to your budget. And from your budget, I'm now saying, let's now have an honest discussion about how much we can save. Once you have built up some credibility with yourself, and I can manage on this limited budget, I'm sacrificing, I'm tightening my belt. Now I can begin to invest. And in investing, it is all about equipping yourself with the knowledge and then taking calculated risk. This to us is the message that we drive. We have a range of investments and we talk about the full spectrum of things that we as Stanbic Bank can do for you. From giving you a savings account, to giving you a fixed deposit account, to then introducing you to the equity markets, to SPG securities, to then introducing you to the fixed income bond market that we can also do. And it's a market that has grown exponentially in the retail space, to taking you offshore, to introducing you to our fund management team and our asset management products. The idea is with all these things that you are going on a journey. I'll give you an interesting reflection. Sometimes people will hear through the grapevine that to invest in euro bonds, in hard currency, you need $200,000. And they will use that as a reason to say, investing is not for me, investing is for the rich. Yes, but you can gain exposure to the very same asset, Kenyan euro bond, by investing in a US dollar fixed income fund from as little, and I use the word sensitively, $100. So the point we're making is that if you are, and an important analogy, physical fitness, nobody starts out as Mr. or Miss Kenya. You start out with goals and hopes for your personal fitness. You do them for a week, you give up, you come back, you do it for a month, and if you're fortunate, it becomes part of your lifestyle. The very same thing can be said about the discussion we're having this evening. Even for the individual who finds himself in a place not only without the resources to invest, but in debt. By all means, allow this conversation to leave you at live and enjoy. Work on addressing your debt situation. Work, if you want to go back to create and build, on a different plan. Very often people will make career changes because they need to earn more money. There is absolutely no shame in that. So I know it's not as simple, particularly if you find yourself in a place of lack, but the message is one of hope, and we believe we can walk this journey and take people from one place to another.
One reflection for me here is that right now you may not be able perhaps to meet that 7 invest bit, but it's a goal that you should actively work toward. And I think that's a mindset that we can also all work towards. We may not be there yet, but hey, can we spare some 10 shillings from a little bit of what we are spending to be able to just push it a bit into the savings bracket? I think that would be something that I would personally consciously tell people. Is that something you can agree with me on?
I certainly do. You're very right. And I don't know where we get this concept, and I don't know how it evolved, but it appears to be a unique challenge of, shall I say, the current generation and the one just preceding. This idea that I need a lot of money to start investing. And there is certainly an element of a vicious cycle about it. If you convince yourself that it takes a lot of money to invest, so I will not invest, you are unlikely to be able to create the resources that will then amplify your wealth journey. and you become stuck in this cycle of inaction or procrastination, which is a real thief of value. I have seen, and I can share with you examples, and I have one particular one that has never left me. It was from a gentleman who I never got to meet, but who would send through back in the days in the envelopes that had the red and the blue on edges. A very modest check, but he did so faithfully once a month for as long as I can remember when I started at about 25 years ago. The amounts were never astronomical. They were modest. We're talking in the hundreds of shillings, not the thousands of shillings. But he would send this amount. And one of the days, because then we were not doing portfolio management, we were stockbrokers, we bought and sold based on instruction. But when I finally did get a glimpse of the portfolio this modest individual was building, I was taken aback, because I can assure you, the amount then was more than people who have much more by way of disposable income. So I cannot agree with you more that it is one message one should take away about from this discussion when it comes to save and invest, is that the power is in starting now, and then keep at it. Consistency and discipline have no replacement. That is how you will maximize the benefits of the market. We call it timing the market vis-a-vis, or says timing the market. Too many of us like the idea of catching things at the bottom, selling at the top. It sounds nice, a script for a movie, but not real life. In reality, you find a stock moving, you jump in, you stay with it, it goes down, you keep faith if it makes sense, and you create wealth over time. So Eric, thank you for highlighting that point. I hope it encourages anybody. And we must applaud, I think, at the great progress in Kenya. A lot of the institutions, the Capital Markets Authority, the Nairobi Securities Exchange, players like ourselves, lowered the thresholds for participation. There was a time it seemed like people were still trying to keep out beginner investors. But today you will see thresholds have been lowered significantly, particularly when you talk about money market funds, fixed income funds, which are designed really to allow you to begin to participate in the investment journey.
Well, that not investing at the NSD itself is very easy. I think sometimes you just of being afraid. It's okay. Take your few shillings, put them up in the market, see them go up and down, and it's part of the journey. I think that's how you get started.
Please, Rick, and maybe Eric, before we move, allow me to address that fear. I cut my teeth at the stock market, and it actually has been very sad to see how Kenyans, shall I say, the majority of the public have lost faith with the stock market over the years. Regularly, you will see that the participation at our own very stock market, trading our companies that we patronize, that we give our money to, is mostly foreign. So it's people in other markets, in other parts of the world who see value in the things that we appear not to. And a lot of it is driven by negative experiences that have now become a fear and a deep risk aversion. If I can just illustrate, like I said earlier, if you invested in Safaricom at the beginning of 2025, as of a week or so ago, you are looking at returns in excess of 50%. Safaricom is the largest listed company in Kenya. It is the most profitable company in Kenya. I dare say it is a no-brainer to put your money there. But sometimes the fear of having had your fingers burnt in the past can hold you back. We're very proud as an organization of the research we put out, and we talked about the investment in knowledge. I think the counter to the fear that appears to sometimes keep investors from taking action is knowledge and information. And we would be very happy to share with your listeners on different forums the research reports we have, the insights we have that are actionable and can actually help you overcome your fear and act with knowledge and insight. I thought I'd just make that point.
We just shared step 3 of 5. The first one is create and build, where we talk about how you can expand your skill set, be able to expand your knowledge base, to be able to earn a bit more. We talked about living in joy, where we want you to be debt free, and at the same time think about asset acquisitions, even though they're modest sometimes. Even invest, where we're saying you don't have to have a lot of money, but you can get started from one. Now, I want to deal with one bit that a lot of people don't talk about, but I think my being in Scandinavia a bit for a while has made me quite conscious of the need to do this. And actually this week I've been listening to a podcast that is titled What the Dying Can Teach Those Who Are Living, about share and legacy. Legacy is all about how do you leave something behind for the next generation? How do you leave something for yourself? at least in old age. So, Kinori, how can you help us think about this phase?
Thank you for guiding us so well through it. We are at step 4.5, which is about shared legacy. Allow me just to make a slight reference. You talked about live and enjoy living debt free. Now, for need of clarity, I'm not saying you should never take a loan. That might be a career limiting move on my part. We're saying manage your debt so that you get to the point where you can be debt free. On a light note.
It's very important to clarify that. Debt free in the sense of my mind was more fixated on the loans that a lot of Kenyans get themselves in with very high interest rate and very punitive measures. So I think that aspect of debt that can actually be detrimental to your long-term financial survival. But debt well taken out when you take it to build assets, to be asset generating income, I think that's good debt.
Absolutely. And we do certainly encourage that you deal with reputable financial institutions when you're dealing in debt. But I think the point is well made and we are aligned. We are talking about legacy now, and we call it share and legacy. And the idea is, how do you make a difference? It could be for your family, it could be for your community, it could be about impacting future generations. And if you want to think about it holistically and understand what are these guys at Stanbic all about, for us, the money discussion is both about value, when you think about create and build, save and invest, but it's also about purpose. And purpose for us is captured by live and enjoy. What are you putting your money towards? And then share and legacy. What do you stand for? Now, I want to make a distinction. Sometimes we confuse wealth transfer and legacy. Wealth transfer is about what can I give you? Is it land? Is it cash in the bank? Those things will happen. Now, I dare say wealth transfer will happen whether you like it or not. It will go to the government, it will go to the people you designate, if you write a will and that will is not contested. But legacy is not as assured. And for us, legacy is about what did you stand for? What were your values? What would you want this wealth that you have created to achieve? Is it the education of people who are less able? Is it to establish causes that resonate with who you are? These are quotes we have, and I think it's very important when we're having the wealth discussion to balance it. But it's attributed to a brilliant mind, Albert Einstein. And it says it's every man, and we have added woman's obligation, a man in the general sense, to put back into the world at least the equivalent of what they take out of it. So for us, legacy is all about giving back. And we believe it balances out this acquisition mindset of wealth, and it gives purpose to it. And when we talk about it, because you've talked already about people now say, okay, there you go again, Mr. Stanbic, you've lost me, because they talk about giving, I barely have enough to hold on to myself. We're not just talking about money. We are asking, what are the different things you do? It could be your gifts, it could be a talent you have, it could be to help people learn how to read. If you yourself learned how to read well, it could be volunteering, it could be helping the elderly, it could be creating order in a political process, being civically minded. The idea of giving back is very broad. Don't limit it to, do I have enough money to put it in a will as going to somebody? But a will is part of it. A will is part of it. And for us, legacy is also about saying that you can do it as an individual. Sometimes we seek the confidence of doing things as a collective. And Mother Teresa is quoted as saying that she alone couldn't change the world, but she could cast a stone across the waters to create many ripples. So financial fitness graduates are challenged to create those ripples. You spent an evening with Eric and I. You've heard about the things that Stanbic can do. Some of them may make sense given where you are in your financial journey. Some may not yet be relevant. But what does make sense? Can you share with your family, socialize? I'm having this conversation with my 13-year-old son in the room because I want to create a legacy of financial fitness in him. I want him to hear the message about financial fitness before he earns his first salary. So sharing legacy is saying, what do you have and how can you deploy it for the good of society, the good of your family, the good of the world at large?
Now, to the final step, plan and protect. What do we need to learn there?
If you recall at the beginning, I said this is all about our best efforts. This is Stanbic Bank, part of the Standard Bank Group, saying, Jipange, organize your affairs, leverage your skill set and create and build. work with that budget. And I'm telling you, believe me, a budget will save your financial life. The discipline associated with it will allow you to become financially resilient. We've said save and invest is not a luxury. It's not an easy place to get to. It is a journey. Work towards it. Start with saving, move into investing, and then accelerate your progress. Sharing legacy, we said give back as you create. But then there are these things that come. Sickness, death, and too often, particularly in African society, when these things happen, they set people back. You find yourself motivated by love and care for those around you to deplete those savings we've spoken about, to liquidate those investments prematurely. And we are saying there are solutions for that. There are solutions like insurance. It is designed to help you deal with that financial burden that you cannot quite predict. But very often we see insurance as an expense that can be done away with. But we do so at a risk to our financial resilience and stability. The statistics are rife about the rising cost of care, either on an emergency basis, but even more when you think about post-retirement medical care. And this is a gap that we've identified, that many people are working, are creating, are investing, but somehow I'm a blind spot for what happens when the company I work with or for is no longer supporting my medical care. Will my retirement be all about taking care of my medical bills? Now, we wish each other good health, but we know the reality is that medical costs tend to increase in retirement, not to decrease. So in Plan and Protect, we tell you that, one, articulate your plans. Write that will, not when you are full of assets, but when you begin to acquire them. When there are things to your name, write a will. A will is a simple legal document you're explaining how things should be dealt with. And then look at the areas of your life where you're exposed to risk. It could be in assets that you own. It could be in your own health. It could be maybe you travel regularly and you want to ensure that you have adequate travel insurance. It could be the education of your children, which is something that's close to many people's hearts, and you have a concern that, yes, I have a plan and I'm working towards it, but what happens if I am not there? Should that education deem not be achieved? And for these things, we say, take insurance. And we walk participants through the fundamentals of insurance, illustrating that, yes, there are many different types. Not all would be required, but certainly it does not appear wise to say, I do not need any insurance at all. We distinguish between short-term insurance, a very popular one for many Kenyans, but also introduce long-term and life insurance. Why are you so passionate about protecting your car, or obliged to do so legally, but not as interested in protecting your health? I will illustrate finally something we have pioneered at the time, an insurance product that deals with last respects for you and your family. Because many people can relate with the idea of death coming, not only with its tragedy, but also with the financial burden associated. And we said you can plan for it. And you can do so in a manageable way through monthly payments. And we've seen our Flexi Protect policy, which is a last respects cover, gain traction with people because people aren't opposed to protecting themselves, but they want to do so in a way that doesn't then limit them from doing other things. So once we are done with that, Eric, we have then navigated the full wealth framework. We do so with insights and case studies. And perhaps if the opportunity does provide itself one day, your listeners can participate in a fully fledged financial fitness academy run by my colleague Elsie Minor and go on this journey for themselves.
Thank you so much. You've taken us through a really good journey, a lot to reflect on. There's a question here from the audience. As someone said it way before you even started. What specific investment or savings tools do you recommend for Kenyans looking to protect their wealth while achieving long-term financial growth? And we are basically asking, are there two that you can recommend? Talk a little bit about some of the offerings that you have at Stanbic Kenya in this regard.
I'm happy to do that. And once we're done, you wouldn't be surprised. We often tell you that once you've had this whole discussion, you will do yourself a favor by actually now engaging us and saying, okay, that's the field, but now what can we do? We have a full range of investment and banking solutions available. The principle, and we perhaps didn't dwell on it as much as perhaps we should, but when we were talking about risk, if I understand where the listener is coming from. This is the thing to understand about risk. Risk is not guarded against by finding that perfect investment that is risk-proof. People thought it was gold once. It's been proven wrong. You might think it becomes this or that. How you guard against risk is to build a balanced and a diversified portfolio. And balance does not mean 50-50, but it does mean that you spread your assets. Now, there's a well-known spectrum of investment assets, and it starts with cash that, as its place, tends to earn a lower return. Money markets have gained a lot of currency of late. You can invest in money market fund in US dollars or Kenya shilling. I would draw your attention to money market in US dollar, because not a lot of people are looking at not just a return you get on a hard currency that tends to be somewhat insulated against inflation, but also the traditional and historical trend of the Kenya shilling against a basket of hard currencies. In the recent past, people have generated very healthy returns by simply holding hard currency. Say what you will about Kenya, but we must be thankful we are part of a country that is part of the global economic system that allows us to transact in a currency other than our own. So that's the first thing I would draw your attention to. And then I did speak about shares. If you've been ignoring shares because you believe it's gambling, you believe it's no value, year to date, the whole market as a collective is up 20%.
Last I checked, it's only around 5 or 6 stocks which have not gone out this year.
Absolutely. So I would ask, why are you not participating in this renaissance? The market has been moribund, it has been quiet, yes, it put you off, but do not let that history stop you from earning returns that are owed to you as a Kenyan from your own market. So I'm saying the money markets make sense. I'm saying equities cannot be ignored. A year ago, I would have been speaking about fixed income as well, but I think we all know that interest rates have come down. There is a place for investing in bonds, but do wisely and in a balanced fashion. So your listener asked for 2 suggestions. I've given 3, but I would dwell on the opportunity we're seeing in equities at the moment, not to be ignored. And certainly, we'd be happy to speak to you about our US dollar fixed income fund, our Kenya shilling money market fund, and more issues to follow.
Having had all that, I think a basic question any Kenyan can ask is, what should they start? With a lot of information, is about the 5-day, but they don't want to start somewhere. We want to be personal, financial resilience, and financial fitness journey. What would you advise them?
So my advice, and like we said, I think we've addressed people at different parts of the spectrum, but my advice would be start with what is easy. I'm going to leave you with a very hopeful plan. Money markets are designed to get you onto the investment ladder. That is what they are designed to do. You are benefiting from professional management, fund management expertise, low thresholds for entry. 1,000 shillings at Stanbic Bank, you're in the game. $100, you're in the fixed income fund in US dollars. If you bank with us, you can be up and running within 5 to 10 minutes by dialing star 208 hash, and can also do it on the app. For me, it is the things that you can do. And for us, financial fitness is about not just the knowledge we have. And to your point, Eric, we've talked a lot. You've said many things. Hopefully, we have educated one another. But many people get stuck there, sometimes even confused. My advice is find that one thing. Is it to buy Safaricom shares? Is it to look at our latest research report? And I have not been sent by Safaricom. Eric is right. There are other counters at the exchange. I just talked about Safaricom because many of us can relate to it, and it just so happens to have delivered a fantastic return in this year. I'm saying do what is easy. We have an app that would allow you to trade stocks digitally. It's called the SBGS, which is SBG Securities. Walk into any of our branches, call, go to our website, stanbicbank.co.ke. You will get the information on asset management, on investments, on bank assurance. Wherever it is you can reach us, you can reach me directly. My address will be appearing here at King Garenji on X. You can find me at Financial Fitness as well, Financial Fitness Kenya. You can find LCNI. So there's a number of ways. So please don't let access stop you. I'm really looking forward to engaging with you alongside the team at Stanbic Bank.
Thank you, King Ori. I wouldn't add much more to that. Thank you for your time in terms of helping us navigate bit. I would really want to have you again in the near future. I think to just maybe tackle some common misconceptions about investing that people have. And some of the other things that you can also incorporate is behavioral finance in terms of how people can also look out for some of those biases that become a challenge with how they invest and how they think about that. Someone is asking about welfare groups and alumni associations. So they put together a bit of money here and there, but they don't know where to invest. Apart from money markets, what are some of the places you'd advise them to consider?
I think with groups, and thank you for that, it would be remiss to have not spoken about what we're doing. We have an interesting solution that we'd like to talk to groups more and more about. It's called Chama, the Stanbic Bank Chama app. So I've talked about probably 1,000 apps. I've talked about SPGS iTrader app. I've talked about What Matters app. There's an app for everything you need. If you are a group, an investment group, an organized group, Chama app is where you can first organize yourself and ensure your money is constantly earning some kind of a return. And from that platform, you can then now deploy it into other investments that we are constantly introducing to the platform. So I would like to respond by saying, I think the challenge with groups, if they are not very well structured, like a formal group, can tend to be in the informality. You miss out on opportunities. You take long to make decisions. The Chama app can help you with the administrative aspects of what you're doing while keeping your funds invested. And then as that organized group, and I'm not saying you're not already, we would very be happy to have the session with you as a group. If you can bring a group together, we will talk to you about how we can build up a plan. Henrik, you probably want me to go into my closing remarks.
Yeah.
Okay. I think what we're saying is financial fitness is attempting to make a clear distinction between the financial illiteracy that has become fairly commonplace and the more proactive and action-oriented stance we think as Stanbic Bank we can help our clients and partners adopt. We're saying that you need a partner who has capabilities. We have these capabilities in country, integrated financial services organization, working across commercial banking, investment banking, stockbroking, asset management, insurance. We can do these things for you, and we're inviting you into this discussion where we can then articulate the ways in which we can respond to challenges you are facing and give you solutions. I was reminded that banking has evolved. 20 years ago, we gave you a product. Today, we're challenged to give you a solution. So that is who we are. But the other part of financial fitness is saying, do not outsource a responsibility for where you're trying to get to financially to anybody. Financial fitness is about being at the heart of it. That's why we're taking this time, so that you yourself can articulate the dream you have into our goals, that you then break down that goal into steps, which overcomes this procrastination of I need a huge lump sum. Break it down. Like we said 3 minutes ago, just start. And then once you have started, by backing up that plan with action, we truly believe your dreams will come true. And we hope they do with Stanbic Bank and the Financial Fitness Academy. Asanteni sana.
Thank you, King Ori. A really nice 1 hour with you. If you have any questions, please just reach out to him. And do follow Stan Kenya account and do reach out to the bank to make sure that you sign up so you're able to get your financial fitness back. I realized, King Ori, we didn't explore the investment side so much. We explored the financial fitness a lot, but I think that leaves room for another discussion in the near future. King Ori, you can also share any place they can find you.
I'm on LinkedIn, but I saw a number of people have reached out to me on LinkedIn, so happy to have conversations there. I think my vision with everything I've said is just to wish you good luck, because you also need luck in this.
Thank you, King Ori, for taking time to enhance our financial fitness. All the people in the audience, thank you for the 1 hour you've given us of your time. We appreciate it very much.